In this episode, we're going to discuss some common mistakes that I see with beneficiary designation forms. In the last video, we introduced the concept of beneficiary designation forms. We talked about what they are, and we talked about why they are so unbelievably important in the context of estate planning. If you haven't yet watched that video, I'll put a link below so that you can check it out. So, starting with mistake number one. Naming an individual beneficiary directly rather than naming a trust that has been established for that beneficiary. The common example of this is when you have beneficiaries who are minor children. Often we create a simple trust so that the child, if they're still under 18 or under whatever age you would designate, would receive a distribution from your estate that it wouldn't go directly to the child. It would instead go into a trust. Same thing with things like special needs trust. If you have a special needs beneficiary and you want to avoid an outright distribution going to that beneficiary because it could disrupt their benefits, including Medicaid, Social Security, you would instead have those assets go into a trust for their benefit. Could also include things like spendthrift trusts or any other trust that you've set up for a beneficiary that you don't want to receive an outright distribution. Because many people have their most sizable assets in retirement accounts and in life insurance, and because these assets are passing according to the beneficiary designation form, if you don't get this right, you can completely defeat the purpose of setting up the trust. Another common mistake that I see frequently is not completing the forms correctly. Every institution has a different form, and they vary drastically in quality. I'll give you an example. Some forms do not allow you to include a per stirpes designation. Per stirpes just means that if the beneficiary that you've named predeceases you, then the predeceased beneficiary's share will pass instead to his or her children or their natural heirs at your death. So this is just one example. There are other examples where these forms do not allow for the flexibility that you would want. And this is actually very important. The companies that administer these accounts prefer that if the account holder dies, it's as easy for them as possible to distribute the assets and close out the account. They don't want to be tracking people down and trying to figure out who gets what. It's an administrative burden for that company, and they want to avoid it. So as a result, they set up the forms in a way that make it easier for them, but this may not be what you would want. So what we often recommend in these situations is to use what's called a beneficiary designation rider. And this allows you to essentially describe in your own words exactly how you would want for the assets to be distributed at your death. Most companies will accept them. I have heard of issues with, for example, 401k plans that won't accept them because in their view, this is an employee benefit program and they don't really want to get in the business of estate planning. But what I've found in my experience is that most companies will accept these forms. Now, if this seems like a hassle, most times it's not, but it's extremely important to make sure that it's done right. So if you run into roadblocks, ask for help. You really want to make sure that you get this right. Another common mistake that I come across is not completing the form at all. Remember, these are contracts. If you haven't named a beneficiary, or if all of your named beneficiaries have predeceased you, what happens depends on the terms of the contract. There will be default provisions that outline what happens, and the default provisions vary depending on the company that's managing the account. Some default provisions say that the account is paid to the estate. Others may specify default beneficiaries to include a spouse, children, or other sequence of beneficiaries. Some say that the default beneficiaries are the same as your state's intestacy laws. The point is that the default provisions may not be what you would want. So make sure that you have completed the form. And as in our first example, make sure that it's completed properly. Another common mistake that I see is the form is simply not updated. You may have your husband or wife named as a primary beneficiary, but you haven't included your adult children as contingent beneficiaries. Or your spouse's name, but they have passed away, or maybe there was a divorce. And this could be a big problem because these forms are contracts. What happens when someone dies is in part based upon your designation and in part based upon the terms of the contracts. Some state laws address this situation, but you should still update your forms to avoid this issue from causing problems. So the bottom line is that you want to make sure that your forms are updated. And a good time to do that is when you're taking a look at your broader estate plan. And so I would just encourage you that you focus on making this part of the process, part of the estate planning process, a priority. Another common mistake is naming the estate as the beneficiary on the beneficiary designation form. And I want to be clear, there are times where you would want to name the estate. You might, for example, want certain funds from a life insurance policy or other account to be available to pay expenses of estate administration. Sometimes people purchase life insurance to cover for the sole purpose of covering liabilities, taxes, and other costs of estate administration. But you'll want to make sure that this doesn't cause unintended consequences. Naming the estate can cause your beneficiaries to lose certain beneficial attributes of retirement assets. For example, inherited traditional IRAs allow a beneficiary to stretch out the income tax that's due on that account over a period of years and continue the tax-deferred treatment during that time. Whereas if the estate is named as the beneficiary, it could result in a complete liquidation in year one and trigger income tax on the entire account. There are possible ways around this, but believe me, I've done it, and it creates huge and unnecessary burdens throughout the estate administration process. So it's something that you absolutely want to avoid unless that would be your intent for some reason. In a similar way, maintaining the benefit of the stretch period is important for inherited Roth IRAs, which allow a beneficiary to keep funds in the account and continue to grow tax-free over the stretch period. So this can be a huge benefit, one that you may not want to lose by unintentionally liquidating the account in year one. Retirement assets have great built-in creditor protection, and that creditor protection can extend to your beneficiaries if they are the named beneficiary on the account. The last thing I'll mention in terms of problems created from naming the estate as the beneficiary or not naming a beneficiary and the asset then flows into the estate is that it could cause the account to be frozen during the probate process. If the estate is named as the beneficiary, the asset can get tied up in estate probate. Now, in states like Pennsylvania, where the probate process is relatively straightforward and cost-effective, it doesn't necessarily mean that this will create any major issues, but it's just something that you should consider. I hope that you found this information helpful. If you did, please let me know, and I'll look forward to seeing you in the next episode.